Okay, let's dive right into this explainer and unpack the brutal, multi-front perfect storm that just swept through the tech and chip sectors. If you've been watching the markets recently, well, you know it's been a totally wild ride. But what we just witnessed, it wasn't a random dip. It was a highly orchestrated collision of negative forces. Today, we are going to look closely at the 8 specific triggers that caused an absolute panic, sending shockwaves from the US all the way over to markets in Asia and Europe. We're going to deconstruct this chaos layer by layer. We'll start with macro forces, do a quick tech reality check, look at the looming liquidity drain, and then wrap up with the valuation trap. Now, what's really fascinating here is the stark contrast in the market's reaction. While the Dow Jones barely flinched, dropping only a fraction of a percent, high-flying tech and chip stocks in the Nasdaq completely folded. They crumpled like fragile paper under the pressure of these 8 distinct triggers. It was a targeted collective sell-off of growth stocks. So you have to ask yourself, why did tech get absolutely hammered while the rest of the market basically survived? Let's start with layer 1, macro forces. This is the foundation where the market's optimism really started to crack. Trigger number 1 was an absolute shocker. The U.S. Labor Department released its May jobs report, and the number of new jobs didn't just beat expectations, it literally more than doubled them. The labor market is actually stronger right now than it was last year. And in the beautifully twisted logic of Wall Street, this phenomenal good news was completely terrible news. You see, the market was desperately hoping for the economy to cool down so the central bank could cut interest rates. Instead, because the economy is running so impressively hot, the central bank has absolutely zero reason to lower interest rates right now. Inflation is going to stay stubborn and rates are going to stay high. And bam, that leads directly to trigger number 2, the bond market's instant violent reaction. The 10-year Treasury yield violently jumped to around 4.53%, hitting a multi-week high. The 2-year yield surged to levels we haven't even seen since February of last year, and the 30-year yield, it crossed that massive 5% threshold. Which brings up a really critical question for anyone out there holding growth stocks. What exactly happens when bond yields spike this incredibly fast, and why does it specifically target the tech sector? So the crucial takeaway is that higher rates act like a massive physical weight on tech stocks. Think about it. When you can get a guaranteed risk-free return of around 5% just by holding government bonds, those expensive tech stocks suddenly look incredibly risky. Their valuations are based entirely on profits they might make 5 or 10 years in the future, right? High rates violently shrink those future valuations. This is the gravity that pulled the whole tech sector down. Moving on to layer 2, the tech reality check, missing the mark. Trigger 3 started with the chip giant Broadcom, and it perfectly illustrates the impossible standards of today's market. They reported phenomenal AI revenue growth, over 140% year over year. But the problem lies in the future. Their guidance for the next quarter fell short of sky-high hopes, and management hinted at fierce multi-supplier competition. The result? The stock crashed over 12% after hours. It sent a chilling message. Massive growth just isn't enough anymore. You have to absolutely shatter expectations to keep investors happy. This panic spread globally, dragging the Korean index down 5.5% and sinking European chip stocks along with it. Then, trigger 4 hit. Google announced a historic equity raise, literally its largest since going public, specifically to fund AI infrastructure. This sparked a fierce, fiery debate. The bulls out there argue this proves AI demand is exploding, they have the orders and just need the computing power. But bears see a massive red flag. They think AI is burning cash far faster than it earns it. Actually, by issuing stock after already taking on debt, Google is heavily compressing its short-term free cash flow. Investors are now seriously questioning the true return on investment for the entire AI industry. All right, layer 3, liquidity drain. This is all about capital flight. Triggers 5 and 6 are basically on a collision course for next week, creating a massive vacuum that is already sucking capital away from existing tech stocks right now. We have 2 major events happening simultaneously that are causing investors to aggressively rebalance their portfolios today. Trigger 5 is the historic SpaceX mega listing coming next week. This is going to be a record-breaking IPO. Combine that with 2 more AI super unicorns planning to list later this year, and you have a massive capital sink. To put that into perspective, these upcoming mega listings represent the largest venture-backed capital drain in 2 decades. That's larger than the last 20 years combined. Investors are literally being forced to sell off their current tech holdings right now just to free up enough cash to buy into these massive new giants. Compounding this massive liquidity drain is trigger 6. The terrifying uncertainty around next week's central bank meeting. This is Walsh's first policy meeting, making it arguably the most critical one of the year, and the market is incredibly conflicted. Inflation is sticky, jobs are strong, so the chance of a rate hike is actually creeping up. But here is the real danger. If Walsh doesn't sound tough enough on inflation, investors fear the bond market will simply take matters into its own hands. Bond traders will sell off, pushing long-term rates even higher, effectively hiking rates themselves and pulling even more money out of the stock market. Which brings us to our final layer, the valuation trap. Zero margin for error. Trigger 7 actually comes from kind of an unexpected place, retail. Lululemon heavily slashed its full-year earnings guidance, citing a very sluggish North American market. And listen, this isn't an isolated incident. It shows that high inflation and high oil prices are visibly, undeniably eroding everyday consumer spending. The American consumer is getting tapped out, and that punches a massive hole in revenue expectations for both retail and the broader tech ecosystem that relies so heavily on consumer spending. And that leads right into our final catalyst, Trigger 8. The overall U.S. market cap to GDP ratio has soared to its highest level in history. Plus, another key long-term valuation metric has climbed all the way back up to levels we haven't seen since the year 2000 dot-com bubble. The ultimate takeaway here boils down to this. A highly valued market isn't necessarily guaranteed to crash. But when valuations are stacked this incredibly high amidst rising rates and sticky inflation, there is absolutely zero margin for error. High valuations mean the market's tolerance for negative surprises is totally gone. Any single bad data point, like a hot jobs report or a slight miss on AI chip guidance, can collapse the entire paper tower. But hey, here is the silver lining I want to leave you with. This isn't just a blind apocalyptic panic. If we look closely, it's a very calculated rotation. Small cap stocks like the Russell 2000 actually traded up at points during this storm. Smart money is fleeing these hyper-expensive AI and chip stocks and taking shelter in traditional, reasonably priced defensive sectors. We are seeing capital flow directly into healthcare, finance, and consumer staples, areas that are far, far less sensitive to interest rate spikes. As we wrap up this explainer, I'm going to leave you with this final provocative thought. We have 8 distinct triggers perfectly aligning to pull tech down from its pedestal. But the real test comes in the days ahead. Will next week's massive liquidity test, driven by the central bank and that historic SpaceX IPO, totally shatter the tech market's fragile foundation? Or is this simply the painful beginning of a massive changing of the guard, rotating wealth back into the broader traditional economy? Keep your eyes on the data, folks, because this storm is far from over.